What you are about to hear is not casual commentary. It is not entertainment. It is not another optimistic reassurance that everything will somehow work itself out. This is a final warning for those who hold silver and believe that simply owning it guarantees safety. It does not. Ownership without awareness is exposure. Possession without strategy is vulnerability. And in the current environment, vulnerability is dangerous. Silver sits at a crossroads. On the surface, the market appears functional. Prices move up and down in familiar patterns. Analysts debate targets. Commentators speak confidently about supply deficits or industrial growth. Yet beneath that surface lies a structure under strain. The forces acting on silver today are larger than short-term charts and louder than daily headlines. They are systemic, they are coordinated, and they are accelerating. Silver is not merely a metal. It is a barometer of confidence in currency. It is a gauge of systemic stress. When trust in financial systems weakens, silver responds. When liquidity tightens, silver reacts. When institutions intervene to maintain order, silver often becomes a pressure valve. But here is the uncomfortable truth. The same characteristics that make silver protective also make it a target. In a world drowning in debt and synthetic liquidity, tangible assets represent competition to fiat systems. When confidence shifts toward hard assets, it exposes weakness in paper promises. That exposure is not welcomed by those who depend on perception management. Therefore, volatility in silver is rarely accidental. It is frequently engineered, amplified, or suppressed depending on broader objectives. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Many holders assume that long-term fundamentals will override short-term distortions. They believe that patience alone is protection. But patience without preparation is not strategy. It is hope. And hope is not a hedge against structural intervention. Consider the nature of modern markets. They are dominated not by physical exchange, but by derivatives, leveraged contracts, algorithmic trading, and layered instruments that multiply exposure far beyond underlying supply. The volume of paper silver traded daily often dwarfs physical availability. This imbalance creates leverage, and leverage creates fragility. When positions are forced to unwind, price can move violently in either direction. It does not matter what long-term fundamentals suggest. It does not matter what industrial demand indicates. In moments of stress, liquidity and leverage dictate price. Those who are unprepared are swept aside. You must understand that silver behaves differently under different stress conditions. During inflationary expansion, it can surge as capital seeks protection. During deflationary panic, it can drop sharply as leverage positions are liquidated. Both scenarios can occur within the same cycle. Both can happen faster than most expect. This dual nature confuses the unprepared holder. They expect silver to move in a straight line aligned with monetary debasement. But markets are not linear. They are reflexive. They overshoot. They reverse. They punish consensus. Confidence is the most underestimated risk factor. When investors feel certain that silver will inevitably rise, positioning becomes crowded. When positioning becomes crowded, vulnerability increases. A single policy shift, a surprise rate adjustment, or a sudden liquidity squeeze can trigger cascading liquidation. Prices can fall sharply even if underlying monetary conditions remain supportive long-term. This is not contradiction, it is structure. The global monetary system is operating on unprecedented intervention. Liquidity is injected when markets falter. Rates are adjusted to steer behavior. Balance sheets expand quietly. Currency purchasing power erodes gradually, then suddenly. These actions distort price discovery across all asset classes, including silver. But distortion does not eliminate risk. It transfers it. It concentrates it. It stores it beneath the surface until release becomes unavoidable. Industrial demand for silver continues to grow through technology, energy infrastructure, and advanced manufacturing. That demand provides long-term support. Yet industrial usage also ties silver to economic cycles. If manufacturing slows abruptly, short-term demand can weaken. If energy markets contract, silver consumption may dip. Simultaneously, investment demand can spike or collapse depending on fear and liquidity. This tension creates volatility. Volatility is not inherently negative. It creates opportunity, but only for those prepared to act. For those without a plan, volatility is destructive. Ask yourself a direct question. If silver were to drop sharply in a sudden liquidity event, would you know what to do? Would you add? Would you reduce exposure? Would you freeze? If silver were to spike rapidly on monetary panic, would you have a staged exit? Or would greed override discipline? Most holders do not know. And that uncertainty is the true risk. Another overlooked factor is accessibility. Physical silver provides independence from digital systems. Yet in moments of extreme stress, physical premiums can detach from spot price. Supply can tighten unexpectedly. Delivery delays can emerge. Conversely, paper instruments can freeze or track imperfectly. Each format carries distinct vulnerabilities. The illusion of simplicity is dangerous. Silver is simple in composition, but complex in market behavior. Global debt burdens continue to expand. Governments rely on refinancing at scale. Financial institutions depend on stability in credit markets. When debt levels grow beyond sustainable thresholds, policy response becomes more aggressive. Aggressive policy increases distortion. Distortion increases fragility. Silver sits within that fragility. Currency dynamics add another layer. Silver is priced globally, influenced by exchange rate fluctuations. A strengthening currency can suppress nominal silver price, even if intrinsic demand remains strong. A weakening currency can accelerate price beyond fundamentals. Understanding this interplay is essential. Geopolitical tensions further complicate the landscape. Trade disruptions alter supply chains. Energy volatility shifts industrial production costs. Sanctions reshape capital flows. Each of these forces can ripple into silver pricing unexpectedly. And then there is psychology. Human beings anchor expectations to recent experience. If silver has been stable, they assume stability continues. If it has been rising, they assume momentum persists. This cognitive bias blinds holders to structural inflection points. Inflection points are rarely announced in advance. They reveal themselves through subtle signals, tightening liquidity, unusual volume spikes, divergence between paper and physical markets, abrupt currency swings, or policy language shifts. Those paying attention see warning signs. Those distracted by noise do not. Preparation requires clarity. Clarity begins with exposure analysis. Understand exactly how much of your net worth is allocated to silver. Understand whether that allocation aligns with your risk tolerance. Understand liquidity timelines. Understand storage realities. Understand counterparty exposure if using financial instruments. Then develop scenario frameworks. Scenario 1. Deflationary shock triggers forced liquidation across commodities. Silver drops sharply despite monetary easing. What is your response? Scenario 2. Currency confidence erodes rapidly and capital floods into hard assets. Silver spikes violently. What is your response? Scenario 3. Regulatory or exchange rule changes alter margin requirements or settlement mechanics. What is your response? If you cannot answer these calmly and precisely, you are exposed. Risk is not eliminated by conviction. It is managed by structure. Diversification within precious metals can reduce single asset shock. Holding liquidity outside of silver can provide flexibility. Establishing incremental buy or sell thresholds in advance prevents emotional decision-making. Discipline must override impulse. Education is ongoing. Study monetary policy, monitor real interest rates, observe inventory reports, track global debt issuance, watch for stress in credit markets. These indicators often precede silver volatility. Do not rely solely on mainstream narratives. They frequently lag reality. By the time reassurance appears, positioning has already shifted. This is not about fear. It is about respect. Respect the complexity of modern financial systems. Respect the power of coordinated intervention. Respect the speed at which digital markets move capital. Respect the fragility created by leverage. Silver can be a shield, but a shield must be held correctly. There is no neutral stance. Passive holding without strategy is a decision. And in high volatility environments, indecision carries cost. The greatest danger is complacency born of partial understanding. Knowing that fiat erodes purchasing power is not enough. Believing that hard assets protect is not enough. Without timing awareness, liquidity planning, and structural insight, protection can become temporary exposure. You must move from passive ownership to active stewardship. That does not mean constant trading. It means constant awareness. It means knowing your thresholds. It means pre-committing to action. It means separating emotion from execution. The market will not pause to accommodate hesitation. When shifts occur, they unfold rapidly. Algorithms trigger, margin calls cascade, liquidity evaporates, headlines follow after damage is done, You must operate ahead of headlines. The window for preparation is always before the event, never during. This is your warning. Silver is entering a phase where structural pressures are building simultaneously. Monetary distortion, debt saturation, geopolitical tension, industrial transition, and currency volatility. Convergence of pressures increases probability of sharp movement. Whether that movement begins downward or upward is less important than your readiness to respond. Fortunes are preserved not by prediction, but by preparation. If you respect that principle, silver can serve its purpose. If you ignore it, believing ownership alone guarantees safety, the market will teach otherwise. Now understand something deeper. The greatest losses in markets do not occur because assets lack value. They occur because holders misunderstand timing, structure, and control. Control is the hidden variable. Modern financial systems are layered with mechanisms designed to maintain order. Order is defined by stability of currency, credit, and confidence. When silver's movement threatens that perceived stability, mechanisms activate. These mechanisms are subtle: liquidity injections, coordinated selling pressure, derivative positioning, policy guidance, margin adjustments. Most holders never see these levers move. They only see the result on a price chart. When price drops sharply, fear spreads. When price spikes too quickly, suppression can follow. The pattern repeats across cycles. The herd reacts emotionally at both extremes. They sell into engineered fear, they chase into engineered momentum, and in both cases, disciplined actors transfer wealth quietly. To survive this environment, you must detach from crowd psychology. Crowd psychology thrives on narrative. Narratives simplify complexity into comfort. Inflation guarantees silver rises. Industrial demand ensures scarcity. Long-term holding removes risk. These statements contain partial truth. Partial truth can be dangerous because it builds overconfidence. Silver's relationship with inflation is real but non-linear. During certain inflationary waves, silver lags. During liquidity crunches, it can drop even while prices of goods rise. This confuses those expecting direct correlation. Real interest rates exert powerful influence. When yields adjusted for inflation rise, silver can face pressure as capital seeks income. When real yields fall deeply negative, silver often benefits. Monitoring this dynamic is critical. Another structural factor is leverage. Leverage amplifies both opportunity and danger. If large participants hold leverage long positions and conditions shift unexpectedly, forced selling accelerates decline. If leveraged shorts are trapped during upward momentum, short covering fuels rapid spikes. In both cases, volatility expands dramatically. Physical holders sometimes assume they are immune to paper volatility. They are not. Spot price influences sentiment, liquidity, and resale conditions. While physical ownership removes counterparty risk, it does not remove price risk. Liquidity planning is therefore essential. Ask yourself, in a crisis, would you need to liquidate silver to meet obligations? If so, at what price level? Have you considered transaction spreads under stress? Have you factored in timing delays? Strategic resilience requires separating emergency liquidity from long-term holdings. Mixing the two creates forced decisions at unfavorable times. Diversification beyond silver also matters. Concentration increases sensitivity to asset-specific shocks. While silver can perform powerfully during monetary instability, it can underperform during certain tightening cycles. Balance is strength. Now consider systemic fragility. Financial markets are interconnected through derivatives and cross-asset exposure. A shock in credit markets can spill into commodities. A currency event can ripple into metals. A sovereign debt scare can trigger global liquidation. These cascades unfold faster today than in previous decades because trading is digital and automated. Speed compresses reaction time. Therefore, preparation cannot be reactive. It must be premeditated. Define allocation bands in advance. Determine maximum exposure thresholds. Establish incremental adjustment levels tied to objective indicators rather than emotion. For example, consider linking strategy to measurable metrics such as real yield movements, currency index trends, or volatility spikes. When predefined thresholds are crossed, action follows automatically. This removes hesitation. Education remains ongoing. Study how futures markets operate. Understand how open interest changes can signal positioning stress. Observe divergence between physical premiums and spot price. Watch inventory drawdowns relative to price stagnation. These anomalies often precede significant repricing. Contrarian thinking becomes critical during extremes. When complacency dominates and volatility compresses, risk may be building invisibly. When panic dominates and liquidation is widespread, opportunity may be forming quietly. Discipline allows you to act opposite emotion. Policy risk must also be acknowledged. Regulatory adjustments can alter trading rules quickly. Margin requirement changes can force liquidation. Settlement mechanisms can evolve. These changes often arrive with minimal warning. Flexibility protects against rigidity. Rigidity is dangerous in dynamic systems. If your strategy cannot adapt to new information, it becomes fragile. There is also the psychological challenge of conviction versus stubbornness. Conviction is grounded in evidence and adaptable to new data. Stubbornness ignores changing conditions to protect ego. Many losses stem from refusing to reassess. Silver is not ideology. It is an asset within a system. Treat it as such. Long-term structural arguments for silver remain strong in environments of currency debasement and debt saturation, but long-term does not shield against short-term turbulence, and short-term turbulence can damage long-term positioning if mismanaged. Patience must be paired with tactical flexibility. Another element often ignored is opportunity cost. Capital locked in underperforming phases may miss other protective moves. Monitoring cross-asset relationships ensures capital efficiency. Resilience also requires emotional control. Volatility tests discipline. Rapid declines trigger fear of collapse. Rapid rises trigger fear of missing out. Both impulses lead to poor timing. Predefined strategy reduces emotional interference. Technology has intensified market swings. Algorithmic systems respond instantly to macro data. News is priced in within seconds. This environment rewards anticipation over reaction. Waiting for clarity often means arriving late. Liquidity cycles amplify moves. When liquidity expands aggressively, hard assets may surge. When liquidity contracts suddenly, even strong assets can fall. Tracking central bank balance sheet trends and credit conditions provides context. Context prevents misinterpretation. Silver's dual identity as industrial input and monetary hedge creates complexity. During economic expansion with loose policy, both drivers align positively. During recession with tightening, both can weaken simultaneously. During stagflation, monetary demand may offset industrial slowdown. Understanding these scenarios improves positioning. Above all, abandon complacency. Complacency whispers that holding is enough. Complacency assumes that structural imbalances will inevitably reward patience without preparation. Complacency delays difficult decisions. The market punishes complacency. Preparation does not require constant action. It requires readiness. It requires clarity. It requires acknowledging that volatility is not anomaly, but feature. You are not powerless in this system, but you are responsible for understanding it. Monitor debt trajectories. Observe currency strength relative to trade balances. Watch real yield inflections. Track inventory anomalies. Study volatility expansion patterns. When multiple indicators align, probability shifts. Probability, not certainty, guides strategy. Accept uncertainty. Build flexibility. Maintain liquidity buffers. Define thresholds. Separate long-term conviction from short-term execution. Silver can protect wealth across turbulent eras. History demonstrates that tangible stores of value regain relevance when paper confidence weakens. But history also shows that transitions are rarely smooth. Transitions are chaotic. The question is not whether turbulence will arrive. It is whether you will be prepared when it does. Preparedness transforms volatility into opportunity. Unpreparedness transforms volatility into loss. You must decide which side of that equation you occupy. This is your final warning. Do not mistake ownership for immunity. Do not mistake conviction for strategy. And do not mistake temporary calm for lasting stability. Silver stands at the intersection of monetary distortion, systemic fragility, and accelerating global change. The signals are present. The pressure is building. Act with discipline, prepare with clarity, and remain vigilant. In moments of convergence, the prepared preserve wealth, while the complacent surrender it. The choice is no longer theoretical. It is immediate, and it is yours.